The broad real estate charts distributed by the mainstream media like to hide the truth behind statewide averages. They want you to believe the Florida housing market is experiencing a standard, healthy cooling period after a historic boom. But on the ground, inside specific suburban corridors, a brutal and targeted asset liquidation has officially begun. We are tracking 10 concrete towns where home prices are not just softening, they are falling at an unprecedented velocity. The middle-class families who called these communities home are discovering that their paper net worth is evaporating month after month. This is not a temporary market fluctuation driven by changing consumer tastes. This is a structural breakdown caused by carrying costs that completely broke the financial foundation of homeownership. And this is where things get ugly. Let us begin our investigation in the suburban territory of Cape Coral, a region that came to define the recent housing boom. During the peak, out-of-state buyers flooded this market, bidding property valuations up to levels completely detached from local wages. But in 2026, active residential inventory inside this single municipality has spiked by over 60%. Every single week, desperate sellers are cutting their asking prices by $40,000 to $80,000 just to find a buyer. The regional real estate marketing campaigns continue to feature glossy advertisements claiming that demand remains historic. But the reality on the ground is a massive traffic freeze, as properties sit dark on Zillow for months without single offers. Would you be willing to hold on to an asset in a zip code where property values are steadily decreasing every time a neighbor drops their price? Granted, elite residential districts protected by private infrastructure networks inside major metropolitan centers are maintaining their price baselines. Yet, for the traditional suburban family infrastructure defining the core of Cape Coral, the deflationary spiral is officially accelerating. Moving further down the Gulf coastline, we hit the blacklisted residential markets of Punta Gorda and Fort Myers. These coastal sectors are experiencing the direct impact of an institutional retreat that ordinary consumers never anticipated. As the largest private insurance corporations quietly cancel property protection and pull out of these specific zip codes, the market paralyzes. The global banking networks refuse to clear mortgage loans for any structure that lacks a comprehensive retail hazard policy. Consequently, traditional qualified buyers are walking away from transactions because they cannot secure the financing required to close. The travel brochures continue to market these towns as idyllic paradises designed for a stress-free retirement experience. But the local reality is a transactional freeze that turns beautiful single-family homes into illiquid assets overnight. Do you think it is wise to invest your capital into a coastal market where corporate risk models have officially blacklisted entire neighborhoods? To be fair, institutional investment funds are stepping in to monitor these distress zones, waiting for prices to drop further before buying land. But for everyday homeowners looking to liquidate their equity to fund their retirement, this lending blockade creates an absolute trap. This transactional freeze triggers a dangerous psychological shift across the suburban markets of Palm Coast and Port St. Lucie. When a few vulnerable homeowners face urgent personal emergencies and accept a 30% loss to escape, the domino effect begins. Appraisal algorithms automatically adjust the value of every single home inside that neighborhood based on those distressed transactions. Suddenly, sellers who did nothing wrong discover that their personal household net worth has been reduced by $50,000 without their consent. The real estate brokers distribute public updates claiming this correction represents a healthy entry point for first-time homebuyers. But the real-world consequence is a desperate race to the bottom as neighbors compete against each other for a shrinking pool of cash buyers. Would you maintain your listing price to defend your paper equity, or would you slash your price to guarantee an escape? Obviously, unique custom estates featuring historic structural modifications can command independent pricing metrics that bypass the local trend. But for the standardized, master plan developments that define the middle-class experience, the deflationary domino effect is taking over. Many external observers assume that these deep price drops will eventually attract a massive wave of new buyers back to Venice and Naples. They think if the price falls low enough, the consumer market will stabilize and demand will naturally recover. But they are completely ignoring the permanent carrying cost suffocation that waits for a new owner after closing day. Even if a buyer secures a property at a 15% discount, the ongoing cost of ownership has hit an unaffordable baseline. The combination of escalating state-backed citizens' premiums, adjusted property taxes, and exploding HOA assessments erases the purchase discount entirely. The public economic data claims that housing affordability indexes are showing positive movement across these specific regional sectors. But regular people do not manage their lives with theoretical indexes. They manage them with the actual liquid cash remaining in their checking accounts. Would you purchase a discounted residential property if you knew the fixed annual carrying bills resembled a secondary mortgage payment? To be fair, affluent out-of-state executives possessing massive monthly cash flows can absorb these continuous operational spikes without difficulty. But for the traditional working professional, this overhead suffocation makes local homeownership an absolute impossibility. This structural cost pressure is driving a heartbreaking transformation inside the inland retirement havens of Ocala and Lakeland. For decades, these specific towns attracted seniors on fixed incomes looking for affordable, manufactured homes and quiet community living. But in 2026, these peaceful senior enclaves are experiencing an absolute financial meltdown. Because of updated structural safety mandates, senior community boards are forced to collect thousands in unexpected special assessments. Retirees living on fixed Social Security pensions are receiving emergency notices demanding immediate cash injections to fund community infrastructure reserves. The marketing materials for these active adult communities still promise a secure, low-cost lifestyle surrounded by social amenities. But the reality on the ground is widespread panic as elderly residents place for sale signs in their yards to avoid foreclosure. What option do you possess at 70 years old when your community board delivers a sudden invoice for $20,000? Granted, modern master-planned retirement complexes built within the last 24 months feature advanced capital structures that delay these fee spikes. But for the traditional developments that shelter the true middle class, this carrying cost inflation operates as an eviction mechanism. As traditional middle-class families are broken by the system and forced to exit St. Petersburg and Sarasota, a new entity takes control. It isn't a wave of local working families purchasing these discounted properties to establish long-term roots in the community. It is institutional private equity conglomerates and multi-billion-dollar Wall Street corporate landlords deploying massive reserves of cash. They are moving into these declining markets to sweep up distressed single-family homes at a historic discount. They completely bypass the retail insurance wall because they possess the scale to self-insure their vast portfolios using internal corporate capital. The mainstream business journals celebrate these acquisitions, claiming institutional investment brings vital stability and liquidity to the region. But the ground-level truth is that Wall Street is systematically converting these traditional family neighborhoods into permanent rental zones. Will the next generation ever have the luxury of owning land, or will they exist as permanent renters to a corporate asset algorithm? Naturally, local housing authorities are trying to launch dedicated assistance programs to help working-class consumers defend their home ownership status. But the sheer volume of institutional capital flooding into these declining zip codes completely overwhelms those modest regulatory boundaries. If you are watching this investigation from a quiet suburb in Texas, California, or the Midwest, do not make the mistake of looking away. This is not a localized Florida story. This is the structural blueprint for an unaffordable America. The identical risk matrices and corporate financial tools are being deployed inside your home states right now. The private insurance syndicates are rewriting the terms of property ownership from coast to coast, turning homes into elite commodities. The government agencies continue to publish optimistic statements claiming the national financial system remains perfectly resilient. But the data on the ground proves that the core foundation of middle-class wealth is fracturing under the weight of hidden costs. Take a hard look at your own property renewals, escrow balances, and local tax assessments this quarter. Are you starting to notice the early indicators of this economic squeeze appearing inside your own zip code? Share your local numbers and your personal experiences in the comments section below so we can track how fast this system is expanding across the nation. The United States has historically adjusted to structural shocks, and new legislative boundaries may eventually step in to protect the consumers. But before those macro protections arrive at your front door, independent homeowners must see the reality of the trap clearly. Subscribe to remain informed, protect your wealth, and we will see you in the next economic report.